The breaking point just hit. As of this morning, April 10th, 2026, silver has breached the $76.33 level, a structural ceiling that has stood as the last line of defense for the paper shorts in New York for 3 long years. While the mainstream media is obsessing over distraction stories and political theater, the monetary metal just sent a shockwave through the global ledger that the Federal Reserve cannot ignore. If you're watching this right now from your home in America, pay attention. The window for physical settlement is closing. Right now, as we speak, the bets for a June rate hike have completely collapsed in the Eurodollar futures market. The smart money isn't just pivoting, they are running for the exits. They realize the Fed isn't in control. They are being forced into a massive liquidity injection that could devalue your purchasing power by the time the markets open this Monday morning. Don't ignore this. Not this time. This isn't about jewelry. This isn't about day trading. This is about the plumbing of the global debt system failing in real time right here on US soil. By the end of this video, you will understand why $76.33 was the tripwire for a total structural reset of the American economy. Something is happening in the COMEX vaults in Manhattan today that hasn't happened since the Hunt brothers era of the late 70s. But this time, the primary dealers aren't the ones pulling the strings. It's being called the silver drain, and it's happening in the dark pools where the American public isn't allowed to look. Look at the raw data from today, April 10th, 2026. The paper-to-physical ratio on the New York exchanges has officially reached 420 to 1. Let that sink in. For every 420 ounces being traded on your digital screen at your brokerage, only 1 single ounce of physical metal actually exists in the registered category in the vaults, ready for delivery. The U.S. yield curve has remained inverted for a record-breaking period, and today the American banking sector has officially entered what we call the fragility zone. Have you noticed the glitches in your daily life lately? Maybe your Chase or Bank of America app took 5 extra seconds to verify a transfer this morning. Maybe your local coin shop in your town just updated their website to call for price or out of stock. In the world of shadow banking, these aren't technical errors. These are the tremors before the tectonic plates shift under the dollar. Wait until you see the internal memo from the LBMA regarding the emergency reclassification of silver industrial stock. It explains why $76.33 was the point of no return for Western inventories. The collapse of rate hike bets this morning isn't just a statistical anomaly, it is a surrender of the Fed. The U.S. bond market is telling the Federal Reserve, you can no longer raise rates without imploding the U.S. Treasury, with the 10-year yield spiking toward 4.3% and the dollar index surging. Non-yielding assets like silver should theoretically be falling. But they aren't. They are breaking out. This is the great divergence. It's the moment the market stops believing in the Fed's ability to tame inflation in America. I've been speaking with a former floor trader from the COMEX, someone who spent 20 years in the New York pits. Let's call him the Ghost. He confirmed that price discovery in the silver market has been an algorithmic illusion for decades. But today, the math has finally broken the machine. The industrial demand for silver, driven by the AI black hole in Silicon Valley and the U.S. green energy pivot, is now colliding with silver's historic role as the people's money. When those rate hike bets collapsed this morning, it sent a signal. The Federal Reserve can no longer afford to raise interest rates. The interest on the U.S. national debt has officially crossed the $1 trillion mark annually. If they raise rates further, the U.S. government goes bankrupt. If they lower rates, the dollar dies. We have entered a fiscal dominance regime. This means the central bank is now a servant to the U.S. Treasury. They must keep rates lower than the real inflation rate just to keep the lights on in Washington. Your savings account isn't a safety net, it's a melting ice cube in a furnace. Stop what you're doing. Look at the dollar index right now. The divergence between the dollar and hard assets is the widest it's been since the 1971 gold depegging under Nixon. Consider the Warsh shock. The nomination of Kevin Warsh as the next Fed chair was supposed to signal a hard money hawk. But the market saw right through it. They know that no matter who sits in that chair, the math of the debt is the true master. The U.S. paper market just broke, while the physical deficit, the 6th consecutive annual deficit in silver, is only getting wider. Historically, every major financial reset begins with a collateral crisis. In 2008, it was subprime houses. Today, April 10th, 2026, it is the unrealized losses on the $24 trillion Treasury market. When the value of those bonds drops, the repo market, the plumbing of the world, seizes up. Step 1, the overnight lending rate spikes unexpectedly, which we saw in the early hours today. Step 2, the Fed is forced to launch what they call a permanent standing repo facility, which is just a fancy name for printing money in the dark. Step 3, silver, being the most shorted asset on the planet, experiences a step-up revaluation. This is the Basel III endgame. The Bank for International Settlements has been moving the goalposts for years. They call it strategic asset realignment, but for you and me, it means the end of financial anonymity and the birth of the unified ledger. Why did silver drop 47% in the March correction, only to surge back past $76 today? Because the paper market was used to flush out the leveraged retail traders, allowing the institutional whales to scoop the physical metal at a discount. It was a forced liquidation trigger. If you sold in March, you were the victim of a gamma squeeze unwind. If you held, you are now standing on the verge of the most violent upward repricing in history. Imagine it's Sunday night, April 12th, the silver markets in Shanghai and Hong Kong open. The price doesn't just tick up, it gaps. It jumps from $76.33 to $85 in a single heartbeat. You check your phone, and the trading halted banner is across every brokerage app from Robinhood to E-Trade. You try to log in to move some funds into physical metal. Error 505, system under maintenance. You drive to the local coin shop on Monday morning. There's a line around the block. The owner is taping a sign to the window, out of stock, no longer selling. By midday Monday, the Fed chairman is on every screen talking about market volatility and the need for temporary stability measures. That is when they introduce the spending limits. That is when the exit door is locked forever. There's one specific jurisdiction in the East, a BRICS nation, that just offloaded $50 billion in U.S. treasuries to buy physical silver bars. I'll show you the data from the port of Shanghai in just a moment. This isn't just a prediction. It's a pattern. Historically, bank holidays and currency devaluations are announced when the markets are closed. Friday night through Sunday night is the danger zone. The $76.33 level was the final line of resistance before the vacuum above. Why are the central banks of Russia, China, and India aggressively hoarding silver right now? Why is the silver to gold ratio crashing from 85 to 1 down toward its historic 15 to 1 equilibrium? They know that global debt to GDP has reached terminal velocity. In 2026, the US debt is so large it can never be paid back in current value dollars. The only mathematical way out is a liquidation of the debt through inflation. This is what they don't tell you in college. To save the system, they must destroy the currency. Silver is the only asset that is both an industrial necessity and a monetary safe haven that is still underpriced relative to the money supply. Pay attention to the Sunday night gap. The most violent moves in precious metals happen when the COMEX is closed and the physical demand from the East takes over. The emergency orders to limit bullion exports are already sitting on desks in DC and London. By the time you wake up on Monday, the spot price might be a ghost. Are you holding paper silver or physical silver? Tell me in the comments below, because the distinction is about to become the difference between wealth and zero. This weekend is the threshold. The $76.33 breakout was the flare in the night. The credit default swaps are ticking upward. The eurodollar liquidity is vaporizing. You have a choice. You can keep listening to the everything is fine pundits on the news. Or you can act before the price discovery mechanism is suspended, before the settlement is switched to paper only, before the exit gates are locked for the final reset. Don't ignore the $76.33 signal. Your family's financial sovereignty depends on what you do in this 48-hour window. The system is telling you what it's about to do. The question is, are you listening? There is a shadow strategy, a way to hold your wealth where the central ledger cannot touch it. I've spent years tracking the off-grid habits of the 0.1%, but the sensors are already watching. If this video goes dark, if this channel disappears, you'll know the blackout has started. Watch the silver to S&P ratio. Watch the delivery notices. And most importantly, watch who is selling their paper and buying the real thing. The vault is empty. The clock is at zero. Good luck. To understand why April 10th is the point of no return for American investors, we have to look at the staggering math of the U.S. Treasury. Right now, Washington is facing a $10 trillion debt wall. 1/3 of all outstanding U.S. government bonds are maturing this year alone. At the same time, the traditional buyers of our debt, China and Japan, have been net sellers for months. When the world's largest economy can't find enough buyers for its own debt, the Federal Reserve is forced to become the buyer of last resort. This is essentially the monetization of the debt. It is the silent killer of the dollar's value. The U.S. Department of Interior recently moved to reclassify silver as a critical mineral. This isn't just a clerical change. It allows the government to invoke the Defense Production Act, which could eventually mean the mandatory diversion of silver from the private market into military and infrastructure projects. If you think the current retail premiums on Silver Eagles are high, wait until the government starts competing with you for every available ounce. We are seeing a total decoupling of the physical price from the digital ticker. In some parts of the U.S., the real-world cost for physical silver is already 10 to 15% higher than the spot price on the screen. This is the definition of a broken market. And then there's the Kevin Warsh factor. When he was nominated to lead the Fed in January, silver took a massive hit because the market expected him to be a hard money hawk. But the reality of a $35 trillion debt has set in. Warsh, or whoever ends up in that chair, cannot stop the fiscal gravity. They are trapped. JP Morgan has just revised their 2026 targets, with some analysts suggesting silver could realistically move toward $200 per ounce as the bond market fails. This is not hype. This is a structural analysis of a system that has run out of road. The US-Iran ceasefire announced this week was supposed to be the relief valve for the markets. Oil prices dipped, and the talking heads on CNBC claimed the crisis was over. But look at silver. It didn't drop. It broke out. This is a clear signal that the underlying problem is not geopolitical, it is monetary. The blockade of the Strait of Hormuz earlier this year showed the world how fragile our global supply chains are. But more importantly, it showed that the US dollar-based insurance and shipping system is no longer the undisputed king. The world is moving toward real assets. As we stand here on Friday evening, the lease rates for silver in London and New York are hitting 8%. This is a level that usually precedes a major physical shortage. It means that the big players are so desperate to have metal in hand that they're paying astronomical interest rates just to borrow it for a month. If you have your silver in a digital account or an ETF that isn't fully allocated, you are at risk. In a liquidity lock, the exchange can settle your contract in cash at the last price before the freeze. But if the dollar is losing value at the same time, that cash is a losing bet. The 48-hour window is open. The breakout at $76.33 was the final flare. The smart money has already positioned themselves. The vault is empty. The clock is at zero. Don't wait for the Monday morning headlines. Protect your family's purchasing power while the gates are still open. Watch the Sunday night open. Watch the delivery numbers on the COMEX. The reset is happening right now. Are you ready? The U.S. solar sector alone is now consuming over 150 million ounces of silver annually. This is demand that cannot be turned off. If we want a domestic chip industry and a renewable energy grid, we need silver. The government knows this. The big banks know this. And now, the price is finally starting to reflect it. The era of cheap, manipulated silver is over. We have entered the era of physical scarcity,